So this video, we're going to look at short selling stocks. And if you're new to trading and you're looking to potentially profit from declining stock prices, this is a strategy that could be for you. But before we get started, you got to understand some key factors. So what is short selling? Well, that just involves borrowing shares from your broker and sell them in the market. And the goal is to buy them back at a lower price to make a profit. So a quick breakdown: you borrow shares from a broker, you sell the borrowed shares at the current market price, you wait for the price to drop, you buy back the shares at a lower price, return the shares to your broker, and you profit from the difference. But it's important to note that short selling does carry some risks. If that stock price goes up instead of falling, you're going to face some potential losses. So if you want to improve your chances of success, you have to identify stocks that have a high probability of going down. And here's some factors. You want to look for stocks that have a high short interest. This suggests that many investors and traders are betting against the stock. You want to analyze market sentiment. You want to assess the news, earnings reports, the trends of the industry that you're looking at. Think of using technical indicators like moving averages, support and resistance levels, and trend lines to identify potential downtrends. And of course, conduct fundamental analysis, examining the company's financials, the competitive position, and industry outlook. But remember, you got to research this and you got to understand the risk that's involved before you even think about shorting a stock. So you're also going to need a margin account, and that involves borrowing funds from your broker. So to do that, you have to provide some cash or stock equity as collateral and maintain enough equity to meet the margin requirements. But you have to be aware of the possibility of margin calls. And this is where the broker demands additional collateral or they close your position if your losses are too high. So to manage your risks, consider this. Using stop loss orders is a big deal. Make sure you do that. Monitor your positions. These are not set and forget. And make sure you have sufficient funds to meet the requirements for the margin. You want to make sure you work with a reliable broker that has access to shares. You want to be vigilant of market manipulation tactics. There's a lot of them out there. And just have some strict trading discipline. Now, in the stock market, transactions take 2 business days to finalize. We call that T+2 settlements. So when you short a stock, you're going to need to close your position within this time frame because you want to avoid what we call forced buy-ins. And this is where your broker may require you to close the position at any time because they may no longer be able to lend you the shares. And you're going to make some losses on that. Now, short squeezes. Well, these can occur when heavily shorted stocks experience sudden price increases because of the rising demand and limited supply. So this will lead to huge losses for short sellers if they hold on. Perfect example, GameStop. This experienced a massive short squeeze. The stock price went from about $17 to about $480. And this was driven by a combination of factors. There was high short interest. The retail investor, individual investors. This was coordinated through social media platforms like Reddit's Wall Street Bets. These people began buying GameStop shares. And there was forced buying because as the price went up, short sellers had to buy back shares to cover their positions, further driving up the price. So this short squeeze resulted in huge losses for some short sellers, and it really highlighted the power of retail investors in the age of social media. So to deal with a short squeeze, you got to stay on top of your position and monitor it. Watch out for any unexpected price movements against your position. Look at the stock's float and what's the potential for the scarcity of shares. Most important, pay attention to signs such as sharp increases in trading volume and rapidly climbing prices. When that happens, get out. Now, some people talk about the ethics of it. Now, short selling can contribute to market transparency, can make it efficient, and some people are concerned with ethical issues. You might have market manipulation because of smear campaigns, false information. You might accelerate a stock's decline and worsening losses for long-term holders. You might see excessively negative analysis come out. This is going to generate other outcomes and just damaging the confidence in companies that actually have sound fundamentals. But again, ethical short sellers, well, they provide liquidity. They aid in price discovery. They expose fraud. They expose weakness, and they can actually balance overvalued stocks. Now, short selling can be pretty valuable for traders if you want to profit from declining stock prices. There's some things you have to understand. We covered those. Some traders will go into the options side and look at buying put options. And I'm going to leave you a link, and I want you to download this options free guidebook that we got for you. give you a little bit of insight into options. And if it's something you want to look at further, make sure to reach out to our support. That's support@netpicks.com. Talk to you soon.